Welcome everyone. Welcome to another episode of Wealth Talk by Vivekam. First, what's the latest update this week? Of course, Trump has come back and we've seen a ceasefire between Iran and Israel. The fears and anxieties we witnessed have also somewhat tapered down and things seem to be returning to normal, which we can also observe in the markets even at a global level. We can consider this a bit of relief maybe. If there are no war fears, we can set aside these kinds of external factors for now and expect a few days of normalcy in the coming days. So more or less this week will be a bit of a generic topic, meaning at the portfolio level, when should we make changes and what are the losses if we don't make them on time? This is a principle we've been talking about for a long time. So to support that, maybe at a bit of a theoretical level, Prasad Garu and I have studied and will try to explain some concepts about it.
When everyone else is buying, we worry that if we don't buy, we'll be left behind. For example, if a big institution in the market suddenly needs money and sells 1,200,000 shares, and if the price of that share drops by 20% in the market that day without any reason or news, people panic and sell out of fear or buy out of hope. This kind of behavior, panic selling out of fear or buying out of hope, always leads to severe disappointment for the market or for retail investors. And instead of reacting immediately, take a little more time to analyze and respond. You often have the chance to avoid many potential losses. But in mutual funds, since lakhs of people invest their money with trust, every mutual fund is careful to protect the reputation of the fund house. So when so many rules are being followed, why is it that some mutual funds are delivering outstanding performance while others are not performing as well? What is the reason for this? If we want to find out, is there any specific reason behind it, with the intention of analyzing and identifying that reason, our team decided to look into it. It was quite difficult. Despite the challenges and losses, we started conducting research. How did we do it? We looked at the holdings of every mutual fund, what happens at any given time. We collected all those declared portfolios and gathered data for the past 8, 9 or 10 quarters. That is, we took the top 110 mutual funds, those that have consistently delivered outstanding performance, not just the ones that happen to be at the top of the market once, but those showing strong consistency. So from the top 10 high performing funds, we selected the performing ones and compared them with those in the bottom as well. We tried to do it in a completely impartial way without any reservations whatsoever. We learned a few things. One thing we understood is, why does the government encourage mutual funds? It's because almost every mutual fund is able to maintain a minimum score. That's why, as we thought earlier, no mutual fund will suddenly drop drastically by 20%. This is due to diversification. By combining all the stocks in the portfolio, we checked whether the total sales of that portfolio are increasing, whether EBITDA is increasing, whether profit after tax is increasing, and also whether metrics like gross profit margin and net profit margin are improving. So according to fundamental factors, we gave a 50% weightage and another 50% meaning for individual stocks, as we mentioned earlier. At the portfolio level and now even at the individual stock level, if all these companies are increasing their profits, then they are considered to be in growth. Otherwise, they are not in growth. Once it reaches a certain rate, it's good for everyone to sell. But mutual funds don't sell. That's why overvaluations have also occurred. That is, we evaluated based on what kind of intelligence we used and the percentage of growth and gave it a 25% mark. Similarly, for hold, I checked to make sure it wasn't overpriced and gave that a 25% mark as well. So the first fundamental is 50, and if you add these 225 and 25, you get a total of 100%. We then see how many marks it gets out of that. Now, if you look at the image on the screen at the top left, you can see it says high performing mutual funds and low performing mutual funds. If you select high performance there, 10 have been chosen. If you look at all of these combined over the last 5 quarters, you'll see that the scores are always 91, 90, 90.49, 91, 91.52 and so on. Even when you take the collective average score of these mutual funds, it is always above 90. What does that mean? It means that even among mutual funds that are considered good, these are all above 90. While these funds are able to reach the top, the chances of them hitting 95 or 99 are quite low as a group. Maybe an individual mutual fund might reach that high, but generally if the score is below 90, our analysis shows that their performance tends to be lower. What's the evidence for this? Most of them are above 90. Now, even though we can't look at all of them, let's take one example. Let's look at Motilal Oswal Flexi Cap. Why does it perform so well? Why did it rank at the top in Vivekam's mutual fund rankings? Let's see. In the last 5 quarters, it has achieved 90, 91, 91, 93 and 95%. That means not only is it among the top mutual funds, but it's also performing above its own average. which is why it has delivered top performance. Now, what should we do? Let's also try this with low performing mutual funds in the same way. If you look at the mutual funds with low performance here, even when we combine all of them, they've never crossed 90% except for the March quarter. So what does this mean for us? If you look at these so-called bad performing mutual funds over the past few quarters, actually, it's been almost 23 years. They haven't been able to show an outstanding score since the cutoff level we want hasn't gone above 90%. Their growth appears to have slowed down. But even among these, if some realize their mistakes and are able to improve their scores now, what happens then? Some of those that are now showing good performance might, in the coming days, perhaps by the June ending quarter or the July ending month also, try to slowly move into the top performing category. So what should we understand from this? No matter how big a mutual fund is or how small a new portfolio is, if it can maintain a good score, meaning if it can achieve a good score fundamentally, and in terms of valuation, the chances of our profits or the portfolio's profits increase significantly.
Right. And as Prasad Garu mentioned, this score is, of course, dedicated. We already have a report on it in the works. And maybe in 1 or 2 weeks, we'll have it prepared as well. If you look at the numbers, from almost 2022 onwards, we've processed the portfolios of nearly 27,000 people. Out of those processed portfolios, about 10% have been strictly following the rules and advice we've given. The remaining 90% for the most part are making decisions based on their own judgment or relying on the buying and selling decisions of their surrounding circle. Maybe we can ask Prasad to share a few words about that.
Some people are already investors or subscribers in our program. They know what this portfolio review report looks like. Even if I can't explain everything in detail, whether you have 25 shares, 250 shares, or even 500 shares, what is the effort we make for all of you without making you feel any pain or discomfort? Out of the many stocks you hold, how many are worth holding on to? If they are showing good performance, you can hold on to them provided they are not overpriced, which will be pointed out. For the rest, some will be recommended to sell and some to switch. By sell and switch, I don't mean to differentiate for the sake of it. If I tell you to sell everything at once, you might lose your peace of mind. So switching is also suggested in a considerate manner. Ultimately, your portfolio score should grow tremendously. If your portfolio grows, you get more opportunities. So whether I say sell or switch, the idea is to sell those holdings and invest that cash into better stocks. Investing in good companies is the better approach. Since not everyone can do this, and it may not be comfortable for most people, I provide sell recommendations in different categories. Out of the 27,000 people who have received portfolio reviews from us so far, only about 2,000 to 3,000 investors have actually continued their journey with us, consistently following the rules. Let's try to see whether their portfolio scores have increased or not, because the main point in today's discussion is that if the portfolio score increases, profits will follow. That's what we're saying. If you look at this person's portfolio over the past 2 years, you'll see has been at 93, 96, 95 and only once dropped to 84. If you look here, as of September 24th, he had holdings in 35 companies. 5 of the companies were even overfresh, or it appears as if the growth has been exaggerated. All of these by the 31st of March 2025. After that, the score quickly bounced back to 97.59. Later, it stayed at 98. So what does that mean? It means that as long as you continue to receive advice, even if a stock in your portfolio is weak or even if a stock in your portfolio is overpriced, advice is automatically sent to you and you execute it. That's why if you see, for those who have 100% advisor executed portfolios, this is possible. This is one case. Let's look at another case as well. In another case, if you look at this client, when they came to us, their score was 80 and then immediately after that, it went up to 97 and it was always maintained above 95 except for one time when it dropped to 85. That was on September 24th. At that time, he had 60 stocks and out of those, it was found that 15 were lagging a bit. We advised him to sell all of those, and after selling, what did the score become? It went back up to 96. Now tell me, do these two clients get worried when the market goes down? They do get a little worried, but not as anxious as you do. The reason is their score is good and they know their company is doing well. Now, if you look at the client currently on the screen, all of them used to say, we'll handle the execution ourselves without your help. We never force anyone. Our responsibility ends with giving advice. After that, I don't need to hold anyone's hand for execution. You should handle it on your own. Now, if he says he's achieving 86%, there's a bit of self-praise involved. When he first came to us, his score was 81%. As soon as he started following our advice, the score went up to 100%. But now it has dropped again to 83.76. Out of the 12 companies, 2 are the reason for this. I said to either sell or buy, but you didn't sell nor did you buy. If you act on your own ideas, the returns might decrease. For people like this, the chances of making a profit are definitely lower. But to understand what the cost of inaction is like, let me give you an example. To understand why it didn't grow, you need to look at this person's portfolio. If you look at the shares he holds, in his portfolio, one company grew by 133%. Looking from 2022 onwards, another company grew by 100%. MSTC and another GMDC grew by 100%. Link Pharma also increased even among the top 4. That means even though 4 companies in his portfolio grew by more than 100%, how much did the overall portfolio grow? Just 12.8%. What does this mean? That's about the same as what Nifty delivered. Similarly, we looked at another client. When he first came to us, his score was lower, but over time it increased. This person, however, invested in as many as 488 shares and just sat on them. He took a report from us about his portfolio but didn't do anything with it. Perhaps he did something or maybe he didn't. We don't really know. Even when the portfolio's rate crossed 90 at some point over time, he never made a single transaction. Even now, if you look at it, it's the same. So after learning all this, what should you do? First, gather information about your portfolio, whether you've acted on it or not. If you have doubts after collecting that information and want to know if those who acted like this did well or not, first check if their score improved. If the score improves, you'll gain confidence.
So at this point, again, those who haven't used this service, first and foremost, if you share your portfolio in the report you receive, you need to understand what is held, what is sold, what is switched, and overall what state your portfolio is in. Out of the 27,000 people who have shared their portfolios, 90% haven't taken the next step. So if any of them ask me today to review their case again, revise it and tell them what their score is, we'll also try to explain what form the report will take. We will definitely do this next week. So with that, let me conclude this week. Thank you again for watching.